Hey everyone, welcome back to Collecting Compounders. My name is Sousa, Associate Portfolio Manager at Marnoa Private Wealth. Let's get into it. The US Fed is set to finally start reducing interest rates. The release of the July FOMC meeting minutes reaffirmed that inflation is heading in the right direction and that the vast majority of committee members see that a rate cut in September will most likely be appropriate. What exactly does that mean for the US dollar? Let's take a look at the US dollar index, commonly referred to as DXY or the Dixie. It measures the value of the US dollar relative to a basket of foreign currencies, such as the euro, the Japanese yen, the Canadian dollar, and a few others. The US dollar index has weakened a little over 4% since the beginning of July because of cooling economic and inflation data, and of course, the potential start to monetary easing. The US dollar index is actually at its lowest level since late December of last year. With interest rate cuts now on the table, will the US dollar continue to weaken? Previous periods of the Fed lowering interest rates don't really offer a definitive guide for the US dollar's direction. Outcomes have actually been quite mixed. Historical evidence from 7 monetary easing cycles since the 1970s indicate that the dollar strengthened for at least a year following the peak of the Fed funds rate on 5 occasions. In the early 1980s, mid-1980s, mid-1990s, early 2000s, and the late 2010s. However, in 3 of these cases, the dollar experienced a significant decline right after. Only in 2 periods was a peak in the Fed funds rate followed by a decline in the dollar, the late 80s and the mid-2000s. The main reason for this pattern is that Fed easing has most often come in the context of a weaker global economy. Other major central banks at the time were also implementing policy easing, which contributed to the US dollar's appeal as a safe haven currency, giving it strength. Our view is that the US dollar could weaken a bit on the back of lower interest rates. Fed rate cuts, combined with the market's expectations for a soft landing and durable economic data pushing investors back into risky assets, this is all negative for the US dollar. On the flip side, if the US headed for a hard landing and the economy enters a recession, that would have far-reaching consequences globally. In such a scenario, investors would likely flock to safe haven assets, leading to a rise in the value of the US dollar compared to other currencies. Also important is the US presidential election, which can greatly influence the direction of the US dollar. While we expect that interest rate cuts will negatively impact the US dollar, we are not dismissing the potential for short-term strength in the currency. If you have any questions about what was discussed, drop me an email. Thank you for watching and listening. Bye for now.